Dear investors, welcome to the weekly market update by Phillip Securities Research. Standard & Poor's downgraded European sovereign debt ratings, with France and Austria losing their AAA, down a notch to AA+ on negative watch. Needless to say, Spain and Italy were downgraded, and while Finland, the Netherlands, and Luxembourg kept their AAA, they were put on negative watch. Germany remained unscathed. While this was done after European markets closed, US markets saw a flight to safety into treasuries, so we expect non-German European yields to rise today. The even bigger news is that Greek haircut talks broke down. While the private sector agrees to swap old debt for new at 50% par value, the disagreement lies in what yield, maturity, and collateral. The outcome of this can swing either way, and a default leading to Greece leaving the euro would be disastrous due to contagion effects. You can read more about why we think so in our strategy note dated 29th November last year. The US reported November exports declining 0.9% on weak European demand. Recent retail sales data was weak as well as the unexpected spike in unemployment claims. We are now less positive over the short term for global equities on Eurozone sovereign downgrades impacting deficits, a possible Greek default, US data below market expectations, and the prospect of China loosening being postponed. On the other hand, market supportive reasons like the rate of manufacturing contractions in Europe and Asia having eased somewhat, and unlimited liquidity by the European Central Bank resulting in backdoor QE are still there. Electronics sector in Singapore could also be bottoming out if global sentiment improves. But headwinds are significant, and we don't have a strong conviction over the short term at the moment. Over the larger trend for the STI and S&P 500, we are still bearish. Number one, we expect US growth to surprise on the downside this year due to incomes not rising fast enough to offset a fiscally tighter 2012. Number two, Eurozone fiscal and debt to GDP targets will be missed. Refinancing will be tough, exacerbated by an ongoing recession. And number three, although we believe that China will avoid a hard landing, its slowdown will be a drag on Asian exports. Positive challenges to our view would be the Eurozone process for fiscal integration actually addressing its suboptimal growth path, and if lead economic indicators globally corroborate some kind of resilience. Thank you, and tune in next week to Phillip Securities Weekly Market Update.